Running a business is tough. The last thing you need is to get stiffed by a customer. Evaluating customer creditworthiness is critical. When you sell on credit, you're giving a short-term loan. You wouldn't lend to a stranger without checking them out, right? Same principle here. Proper credit checks help you avoid bad debts that can cripple your cash flow. Healthy cash flow is the lifeblood of any business. Ignoring credit checks is like playing Russian roulette with your finances. When a customer defaults, you lose more than just the sale. You lose time, resources, and possibly your reputation. If your cash flow suffers, you might struggle to pay your own suppliers or employees. A robust credit check process does more than weed out risky customers. It empowers you to make informed decisions. It's not about slamming the door on sales, but opening it to the right customers under the right conditions. When you understand a customer's financial health, you can tailor credit terms that work for both of you. This proactive approach minimizes surprises and helps you manage accounts receivable efficiently. Ultimately, a thorough credit evaluation lays the groundwork for strong, transparent business relationships. It shows professionalism and communicates that you expect the same from your partners. This process fosters mutual respect and sets clear expectations from the outset. Building trust is key in any business dealing, and a fair credit assessment is a significant step in that direction. It's about creating a win-win scenario where both businesses can thrive. Don't be complacent. Credit checks are fundamental to managing risk. Protect what you've built by being smart, not just cautious. That's the foundation of a healthy business. The first step in evaluating a customer's creditworthiness is gathering their financial statements, balance sheet, income statement, and cash flow statement. Ask for at least 2 to 3 years' worth to spot trends, not just snapshots. Once you have the numbers, calculate the current ratio current assets divided by current liabilities. A ratio of 2 to 1 or higher is good, below 1 is a red flag. Next, the quick ratio, current assets minus inventory divided by current liabilities. This shows if they can pay short-term debts without selling inventory. A ratio of 1 to 1 is healthy. Finally, check the debt-to-equity ratio, total debt divided by total equity. Lower is better. A ratio below 1 is preferred, above 2 means high risk. These ratios reveal liquidity and financial stability. Don't just look at 1 year, trends matter. These quick checks help you spot trouble before it hits your bottom line. Numbers tell a story, make sure you read it. That's how you get a dynamic view of their financial health. Financial ratios are just the start. Payment history is crucial. Ask for trade references and actually call them. Find out if the customer pays on time and if there have been issues. Use business credit reports from agencies like Dun & Bradstreet or Experian for a broader view. These reports show payment history, legal issues, and a credit score. Don't ignore qualitative factors. Check their reputation in the industry. Are they known for reliability, or do they have a history of problems? Look at the management team. Stable, experienced leadership is a good sign. Frequent turnover or turmoil at the top is a red flag. Combine numbers, payment records, and reputation for a full picture. That's how you spot a reliable business partner. After analyzing the data, set a credit limit based on the customer's creditworthiness and your risk tolerance. Strong financials and payment history? Offer a higher limit. New or risky customer? Start low and review later. Define clear payment terms. Net 30, net 60, or offer early payment discounts to encourage promptness. Make sure terms are stated on all documents and agreed upon before the sale. Use credit management software to streamline evaluations, monitor accounts, and automate reminders. Technology saves time and reduces errors. Remember, credit checks aren't one and done. Review accounts regularly. Watch for red flags like slowing payments or negative news. Annual reviews for key accounts are smart. Adjust credit terms as needed to protect your business. Stay proactive, not reactive. That's how you manage credit risk effectively. Let's see this in action. Pat's Premium Parts gets a big order request from Wholesale Widgets Company. Pat requests 3 years of financials and trade references. The ratios show tight liquidity and moderate debt. Caution is needed. Trade references say payments are usually on time but sometimes late. Credit report confirms minor delays, but no major issues. Reputation and management look solid. Pat approves a $10,000 credit limit with strict net 30 terms and plans a review in 6 months. Careful evaluation lets Pat win new business while protecting the bottom line.